Hi, welcome to Digging to China. I'm Dong Sean. Thank you for tuning in. Your support means the world and plays a crucial role in the YouTube algorithm. Liking, sharing, and subscribing not only show your support, but also help YouTube recommend my videos to a broader audience. Thank you very much. Towards the end of March, an article published in the South China Morning Post ignited significant interest within the financial sector. It alleged that Xi Jinping himself had intervened, directing the People's Bank of China to resume trading in government bonds on the secondary market. However, it's worth noting that the article's claim appears somewhat exaggerated. The purported basis for this assertion stems from a remark made by Xi Jinping during last year's Central Financial Work Conference. In this statement, Xi Jinping suggested a gradual increase in government bond transactions within the central bank's open market operations. However, it's important to highlight that this statement was not included in official conference summary at the time. Instead, it was only recently published in March within the compilation Xi Jinping's Discourse on Financial Work. However, it's been 5 months since the conclusion of the conference and there's been no action from the People's Bank of China. Is the PBOC intentionally disregarding the directive? Why did the South China Morning Post suddenly highlight this statement? Additionally, does the PBOC's involvement in buying and selling government bonds on the secondary market align with what we've previously discussed as fiscal deficit monetization? Is fiscal deficit monetization the sole solution to China's current debt problem? In this episode, let's thoroughly discuss the topic of the PBOC's bond purchases. To grasp why the South China Morning Post suddenly emphasized this topic, it's essential to comprehend how the central bank conducts bond purchases and its impact on economic regulation. In theory, the central bank has 3 approaches to purchasing government bonds. The first method involves direct purchase of government bonds in the primary market. Essentially, this means the central bank buys bonds directly from the Ministry of Finance, a practice often termed as fiscal deficit monetization. Under this approach, the central bank essentially acts as a money printing press, allowing the government to issue bonds freely, knowing that the central bank will purchase them by creating money. However, this practice is currently prohibited by Chinese law. According to China's central bank law, the central bank is explicitly barred from participating in government bond transactions in the primary market. Thus, legally speaking, China does not endorse direct fiscal deficit monetization at the present. Since direct purchase of government bonds in the primary market is not feasible, the central bank theoretically resorts to buying and selling government bonds in the secondary market. So how does the central bank operate in this market? This brings us to the second method of central bank bond purchase, which involves using repos in the secondary market. This method is routinely employed by the Chinese central bank, where commercial banks borrow money from the central bank by offering government bonds as collateral. For example, operations like a medium-term lending facility and the reverse repurchase agreements, which we commonly monitor, exemplifies this approach. When commercial banks face liquidity shortages, they can pledge government bonds to the central bank and obtain funds, thereby injecting liquidity into the banking system through this mechanism. Lastly, the central bank has a third avenue for purchasing government bonds, also conducted in the secondary market. Here, the central bank can directly engage in purchasing government bonds without involving commercial banks. While this approach is legally permissible and compliant, it differs fundamentally from repo transactions. The central bank assumes the risk associated with bond trading. In simpler terms, when the central bank previously lent money to commercial banks and receives government bonds as collateral, fluctuations in the value of these bonds did not concern the central bank. Its sole responsibility was reclaim the money upon debt maturity and returning the bonds to the commercial banks. However, if the central bank directly purchases government bonds, it must bear the risk of potential gains or losses resulting from fluctuations in the bond market. One can look at the example of the Federal Reserve, which predominantly purchases government bonds in the secondary market. However, in 2023, we witnessed the Federal Reserve suffering a staggering loss of $114.3 billion, setting a new historical record. This was primarily due to the Federal Reserve holding a significant amount of low-interest government bonds, resulting in minimal interest income. Furthermore, consecutive interest rate hikes led to a continuous rise in interest payments to major institutions, resulting in substantial losses. This underscores the risks associated with central banks directly engaging in buying and selling government bonds. In history, the People's Bank of China has only had 3 instances of directly participating in buying and selling government bonds in the secondary market. The first occurrence took place in 2007 when the Ministry of Finance issued special treasury bonds worth 1.55 trillion yuan. Of this, 1.35 trillion yuan was specifically allocated to designated banks. After receiving the funds, the Ministry of Finance sought to purchase foreign currency from the People's Bank of China. Subsequently, the central bank utilizes the proceeds from the sale of foreign currency to repurchase these government bonds from the designated banks. Subsequently, in 2017 and 2022, the central bank made 2 more purchases of special treasury bonds. However, these transactions were essentially continuation of the 2007 operation. Therefore, although the People's Bank of China has had multiple experiences of buying government bonds in the secondary market, it effectively executed only 1 transaction. Thus far, there have been no signs indicating that the central bank plans to engage in large-scale direct bond purchases. So, does their lack of prior action imply an intention to do so now? Here, we need to analyze the potential advantages and disadvantages of such a move. Let's begin with the advantages. If the central bank were to engage in large-scale purchases of government bonds directly in the secondary market, it would create a sudden surge in demand for these bonds, causing a supply-demand imbalance. As a result, the prices of government bonds would rise, leading to lower interest rates. This reduction in government bond interest rates would be favorable for the Ministry of Finance, as it would enable them to issue bonds at cheaper rates. Moreover, with the central bank actively buying bonds in the secondary market, the Ministry of Finance wouldn't have to worry about a lack of demand for its bonds. Investors would be confident that buying government bonds from the Ministry of Finance and then selling them to the central bank would be profitable. Consequently, regardless of the quantity of bonds issued by the Ministry of Finance, there would always be eager buyers. Thus, while direct purchase of government bonds by the central bank in the secondary market may not strictly constitute fiscal deficit monetization, they can be considered an alternative form of fiscal deficit monetization. However, this approach involves an indirect route and incurs additional intermediary costs. Hence, when we observe countries like the United States or Japan, we notice that central banks opt for this method to stimulate the economy. The foremost advantage is the potential to reduce long-term interest rates. Lower interest rates decrease the cost of borrowing for business and individuals, thereby stimulating investment and consumption. However, in terms of interest rate regulation, the People's Bank of China lags behind. This is because the PBOC's long prime rate mechanism still retains certain administrative control elements. Therefore, the primary objective of the PBOC's direct bond purchases is to assist the Ministry of Finance in lowering the interest rates on government bond issuance. This has an indirect impact on reducing the overall financing costs in society. Nevertheless, the PBOC still needs to continue its reform efforts in this aspect. The second advantage lies in injecting additional liquidity into the market. Do you recall the events at the end of last year? The sudden issuance of government bonds by the Ministry of Finance causing an immediate tightening of market liquidity, prompting commercial banks to urgently seek liquidity support from the central bank. However, if the central bank were to directly purchase government bonds in the secondary market, this liquidity issue would be circumvented. With the government's bonds held by the central bank, a substantial amount of renminbi would swiftly enter the market, alleviating the liquidity crisis that commercial banks often encounter. In this scenario, the central bank would proactively manage market liquidity rather than merely react to it as it has done in the past. The third advantage is targeted at addressing deflation, taking a direct cue from Japan's strategies. Through direct purchase of government bonds by the central bank, the Ministry of Finance can issue bonds freely, confident of strong demand and unimpeded by liquidity constraints in the market. As a result, government bond interest rates would persistently decrease, bringing financing costs closer to zero. This surplus of funds enables the government to implement the stimulus measures to revitalize the economy. By effectively allocating these funds with precision, the path to overcoming deflation in the near future could be paved. Lastly, there is a fourth advantage. The central bank can raise inflation through liquidity injections, which would dilute existing debt and help alleviate the current debt crisis. After outlining the advantages, it's crucial to address the disadvantages, which are equally evident. Firstly, there's the possibility of the Ministry of Finance engaging in excessive issuance of government bonds and the reckless investments. This could result in superficially inflating GDP figures without genuinely supporting the growth of the real economy. Given the tendencies of the Communist Party, funds raised through bond issuance may not necessarily be directed towards long-term welfare projects, as these typically lack immediate returns. Instead, there may be a focus on large-scale infrastructure projects or endeavors like semiconductor development to quickly boost short-term GDP numbers and claim success. However, this approach could lead to an alarming escalation of government debt. Once the government becomes accustomed to the benefits of limitless debt issuance, it may be unable to control its spending impulses. Consequently, fiscal discipline could be completely abandoned. Secondly, with the central bank flooding the market with liquidity, excess funds will flow into two primary destinations: bank deposits or the stock and the property markets. To relieve debt, the Communist Party would need to raise inflation levels. Achieving this during a period of low market confidence is challenging, but they could result to government procurement. With the Ministry of Finance freely issuing bonds, fiscal funds could be directed towards purchasing real estate or investing in stocks. As a result, when people observe the government driving up property and stock prices, they are likely to follow suit, sparking speculation in these markets. Meanwhile, as the central bank continues to inject liquidity and keep loan rates low, individuals may rush to take out loans for real estate and stock investments, further driving up asset prices and relieving debt. However, this approach may lead to a significant devaluation of the currency, accompanied by severe inflation, exacerbating wealth disparities between the rich and the poor. The third drawback is the potential complete loss of independence by the central bank, reducing it to a mere tool for the government's monetary needs. While expanding its balance sheet may be straightforward, reversing this process becomes challenging. This path could ultimately lead to the transformation of the renminbi into a devalued currency with no clear exit strategy. Directly purchasing government bonds in the secondary market sets the central bank on an irreversible course. Hence, the conservative faction led by former central bank governor Yi Gang has consistently opposed this move. Moreover, it appears that Xi Jinping isn't pressing too urgently on this matter. Otherwise, given Xi Jinping's authority, the central bank would have already acted in the past 5 months. However, judging by Xi Jinping's recent policy reversals, it seems inevitable that, in the end, they may have to resort to this approach to repay debts. Xi Jinping has effectively neutralized opposing factions within the central bank in recent years, consolidating power and ensuring unwavering compliance with his directives. Therefore, it's only a matter of time before Xi Jinping steers towards fiscal deficit monetization. So, why did the South China Morning Post suddenly release such news? My guess is mainly to entice, similar to the long-awaited but unseen stock market stabilization fund. On March 28th, noticing the A-share market dip below 3,000 points, the Communist Party swiftly directed subordinates to write a stimulating piece. As a result, after the publication of this article by the South China Morning Post on March 29th, the A-share market bounced back to 3,000 points. The impact was immediate and unmistakable. However, I believe the central bank will exercise restraint in the short term, and even if they attempt it, they will control the scale. The main reason is that they still need to maintain the stability of the renminbi exchange rate. To safeguard the exchange rate, they cannot unleash excessive liquidity. Didn't Xi Jinping convene a meeting with American business elites recently? Since they are still seeking to attract foreign investment, they cannot afford a plunge in the renminbi exchange rate. Therefore, unless Xi Jinping completely turns against the United States, no longer expects to attract foreign investment, and decides to close off the country in frustration, there is no immediate need for a significant injection of liquidity or debt monetization. Even the South China Morning Post supplemented a report the next day on March 29, stating that despite Xi Jinping's intentions, the central bank still intends to exercise caution in bond trading, which can be seen as a way to save face. Therefore, it's possible that we've all been manipulated by the South China Morning Post. Nevertheless, with the A-share market returning to the 3,000-point mark, they've achieved their goal. As for how people choose to interpret or speculate on this matter, they probably aren't too concerned anymore. Thank you for watching. Please like, leave a comment, and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly. Until then, be well.